Joining us now for our strategy session this week is Meyer, CEO at RMB Morgan Stanley. Thanks so much, Chris, for joining us today. Well, hard to ignore what's basically a red wall today, no matter which market you're looking at. So just how panicked are you right now? How panicked are your clients?
We saw a bit of capitulation yesterday. Yesterday was far and away the biggest volume day of the year. Not so much here, but internationally. Kind of twice the 20-day moving average volume. So a really big day, which does suggest that there was a fair bit of panic. We saw mostly hedge funds on the sell side. So either taking off risks, long risk positions, or putting on some shorts. We haven't yet seen a lot of what we would call institutional buying, so the more long-only type money, longer-term money buying this market. And I actually think in order for us to hit a bit of a floor, we probably do need to see those guys who've got real cash, so to speak, come into the market to really make a statement that, look, the market's fallen far enough. There's value there, let's start buying, and we haven't yet seen that even today.
Of course, because that's while value may be the appeal on one hand, you've got to go have those confidence levels happening in tandem, and that's currently not there. We've got all eyes on that NonFarm Payrolls number out of the US later today, and that where the largest headwind to economic growth has been the high unemployment rate. What kind of attention are you paying to data like that?
Yeah, I think it's the single most important data point we've had all year. So, I mean, it happens to be on a Friday just before everyone goes on holiday, not just here, but also in the US. So it's going to be interesting to see how people react. The tendency ahead of a long vacation period is that people want to take risk off. So, but you don't know how the market's positioned. They might be short, and so a good number they have to cover, who knows. But look, our view is actually a better non-farm payroll than the consensus. So on the back of that, Morgan Stanley's view is 120,000 jobs are created. I think the consensus is 85. If our economists are right, we should be buying the market, because I think the market would rally if we have a better number. And the reason is because if you think about it, there's really two risks out there. The one is that Europe can't figure itself out, and it manifests itself through some kind of collapse of the European banking system, because there's a liquidity crisis caused by a crisis of confidence, because Europeans, it's so uncoordinated that they actually can't find a solution. So that's the one risk. The other risk is that we don't get economic growth. So all the stimulus doesn't actually cause growth. And then what do you do? Because you've got no tools left. You can't cut rates anymore. You can't do any more quantitative easing. So if you've got no more tools left and the economy is not growing, then what happens?
Then what happens? And yet we've still got a debate raging on whether or not we're going to see QE3 emerge out of the US. So what's your view on that? I mean, you use the phrase "who knows," and many people are of that same kind of viewpoint. But what sense are you getting at this stage?
Look, I think it depends on what happens now over the next few weeks. If the markets do react negatively and it looks like there's a bit of a crisis of confidence, I think they are going to have to come up with something. The problem is, if you look at prior market corrections in either 1998 or 1987, interest rates were high enough at that point where the Fed could cut rates. And by cutting rates, you stimulate liquidity and confidence, and then you recover. Now, we've had that rally. We had that rally in 2009. Now we're in a situation where if we collapse from here, stock markets, bond markets, there's just no tools left really that you can use to re-inject liquidity and confidence into the investor.
And also possibly confidence in those tools and their effectiveness already shot down.
Exactly. And that's why, so look, I think if you're a believer in that situation, you shouldn't go anywhere near risk assets, because then there's very few tools that can be used to try and support risk assets. Okay. However, if you believe that the global economy is trying to heal and corporate balance sheets are in decent shape and emerging markets are still growing, then actually a 10 to 15% correction, which is already where we're at, maybe we go another 5 to 10% lower, that starts to become an interesting time to buy risk assets, because it's better than cash, frankly, that's yielding very little.
So let's get into where your beliefs sit at this stage of the game, and are you seeing interesting enough opportunities? How are you navigating around things right now?
Yeah, so the things we look at to figure out, I mean, the whole thing is the market, even if economies are healing and, as I said, corporates are okay, what signs do you use to assess whether an equity market is overreacting? Okay, so you can look at valuation. We're okay, we're not great. Okay, if you look at dividend yields or PE multiples, we're sort of in the average of long-term averages, so we're not cheap. You can look at the VIX, which is the US options market, and generally if that goes high, there's the anticipation that there's going to be lots of volatility. It's a sign of lack of confidence. We're at 32 today. In 2008, in 1998, we got to 40, okay, not far away. And then we look at capitulation indices, which is a sort of combination of a whole lot of things. And we're at -1 at the moment. In prior crashes, we've been at -3. So we're not quite, we're getting towards oversold or capitulation, but it's not panic stations yet.
Okay, well, let's hone in on some potential opportunity, and I don't know if it presents opportunity. You've certainly been doing some work around the South African consumer in particular, and important to look at the retail space specifically. Are you seeing opportunity in the retail segment, where certainly foreigners have seen the appeal, but locally we've had that debate rage on whether or not we're looking too expensive right now?
Sure. I think if you are South African investors, most of them would probably say the banks offer better equity exposure. Well, the bank stocks, if you like, are a better way to play the consumer than the retail stocks, because retail stocks have gone up a lot and bank stocks haven't done much. If you talk to the foreigners, they're much more interested in the retail stocks. Okay, so there's this interesting debate going on. We had a field trip up to Polokwane last week. We went and visited all the retailers with the retail CEOs, and to me, what came out of that is there is one stock that I think looks very interesting, which is the Fashini Group, actually. Okay. And not because I can tell whether their fashion is on the money or whatever, but it's cheaper than the retail sector by quite some margin. I think it's low double-digit PE multiple, and it's historically traded at that discount to the sector because it's been operationally challenged, and I think they've really started to turn it around. So there's substantial sentiment, valuation, operational upside.
How so? What kind of turnaround are we seeing in their operations?
They're selling more because they're getting their fashion right. They're in sports, and sports is a good category. They've got lower margins than everyone else, and their margins are coming right because they're just doing better things operationally. So there's quite a few things, self-help, that they're doing, as opposed to just waiting for the consumer in South Africa to see whether they can carry on consuming.
What's your your sense of the health of the South African consumer right now? Because their particular distinction will have to be made in terms of the various LSM groups, where just so much is going on, influencing those at the lower end of the wage bracket as opposed to those at the top.
Yeah. Okay, so we think middle income consumer outperforms both high end and low end. Okay, and the reason is because high end's got debt, and they're not really getting much of a wage increase, and so if rates go up, the debt costs more, and because they're not getting much real wage increase, they're not getting more money in the pocket. The middle income guys, there's a bit of employment there, and there's certainly real wage increases, and they're less levered. So that to us is the sweet spot of the consumer that's growing the best. And the low income group is also seeing reasonably good real wage increases, but as a percentage of overall spend, it's such a small component. It might be relevant for some of the low-end retailers or maybe the food retailers, but when it comes to Truworths, Fashini, they're just not shopping there, so it's irrelevant.
Yeah. Well, certainly what we've got out of you is your pick within the retail space, so thanks so much for having joined us this afternoon. Chris Meyer, of course, CEO at RMB Morgan Stanley, with us this afternoon.